Hello everyone, my name is Wei, and today I will be presenting on the topic of options contract, specifically selling stock call options. Please check out our derivatives playlist to get a basic understanding of how options contract works. And without further ado, here is selling stock call option. Recall that a stock call option is a contract that gives the contract owner the right to buy the stocks at the strike price. Because the contract owner has the right to exercise the contract to buy the shares, the contract seller/writer has the obligation to sell the stock. There are 5 items we can find on the call options contract, and they are contract type, company's name, strike, expiration date, and the cost of the contract. The cost of the contract is also called the premium. The contract seller collects the premium by selling the contract. A call options contract seller achieves maximum profit when the stock price stays at the strike price or below the strike price. Thus, the intention for selling a call options contract is neutral to bearish. Let's look at an example. Company XYZ is trading $100 per share, and Harry is interested in selling a call option that has strike of 100. Meaning if contract owner exercises this contract, Harry will have to sell XYZ stock for $100 per share to the contract owner. For simplicity of this example, each contract translates to 1 share upon exercise, and the contract costs $1. So, Harry sells a call options contract for $1. Now, 3 things can happen on the day of expiration. Stock XYZ can go up, down, or stay where it is. Let's examine those 3 scenarios. In scenario 1, stock value of XYZ increases from $100 to $200 per share on expiration date. The contract owner will exercise the contract, and Harry will be obligated to sell 1 share of XYZ to the contract owner. But since Harry do not own any shares of XYZ, Harry will have to buy a share for $200 from the market, and then sell the share to the contract owner for $100. Harry will lose $100 in the transaction, but since he collected $1 from the premium, his real loss will be $99. In scenario number 2, the stock value remains at $100 per share on expiration date. At this point, the contract owner may or may not exercise the contract, because the contract owner can buy the shares for the same price through the exercise or through the market. In this scenario, Harry will have the maximum profit, which is that $1 premium. In scenario number 3, the stock value drops to $50 per share on expiration date. At this point, the contract owner will let the contract expire worthless, because he can buy the shares from the market cheaper than he can through exercising the contract. In this scenario, Harry will profit $1 from the premium. From those 3 scenarios, we can create the profit and loss graph, where the x-axis is the price and the y-axis is profit and loss. Because Harry collected $1 in premium for the contract, the maximum profit will be $1 when the contract expires worthless or the stock price stays at 100. And if stock price goes to 101, the contract owner will exercise the contract, and Harry will have to buy a share from the market for 101 and sell to the contract owner for 100. Since Harry collected $1 in premium, 101 stock price is actually the break-even point. At any price point above 101, Harry will lose $1 for every dollar increase, because Harry will have to buy stock at higher price to sell to the contract owner for $100. Now, if we take away the specifics related to our example, we have the generic profit and loss graph for selling call options contract. In the next video, I will talk about the application for selling call options contract. Thank you so much for watching. In this channel, we present on investment topics with plenty of examples. We cover investment terminologies, value investing, speculative investing, investment mathematics, and investment tools. Share, thumbs up, and subscribe if you like the video.